History of insurance. Some find it hard to believe that insurance is much older than I am. Insurance has a long history, and the story I was told was that the Chinese are to blame for insurance. About 3000 BC, 20 families grew crops of rice on the banks of the Yangtze River. They carried the spare crop in the family boat to the rich markets in the capital. The river was often in flood at this time. On average, each year, one of the 20 families lost their boat and crop in the dangerous river journey. Being civilized people, the other 19 families helped the unfortunate family through their year with no money. It was quickly realized that reliance on the charity of the other families produced an uncertain future. Some found it hard to match the generosity of others. It was always an uneven effort, likely to break down due to the perception that some families were avoiding their responsibilities. A proposition was accepted that if a boat was lost, each of the successful families would donate 10% of their crop to the unfortunate family to make up for their loss. It was decided to hold a pool of money to fund the unfortunate through the year of poverty. A Scottish cleric decided to do the math and end the poverty suffered by the families of a vicar if he died. He calculated the average number of deaths in the group and how much money was needed to fund the family that lost their home following the death. The Scottish Widow Fund was the first insurance in Britain. Insurance still collects premiums into pools, adds investment income, and from this pool of money pays claims, administration costs, and provides a return to those owners and investors who will supply the additional risk capital that is required to back up the insurance pool if losses exceed the expected amounts. Benjamin Disraeli talked about lies, damned lies, and statistics, and I used to think they referred to insurance. Lies, what the proposer put on the proposal form, damned lies being the policy wording, and statistics being a basis for arriving at premiums that had no basis in reality. Insurance has tended to focus on replacement of assets lost through some fortuitous event, such as fire or other defined peril. In the early days, it funded shipping losses at sea as Britain grew their empire. Unfortunately, business insurance covers perhaps 50% of the risk faced by small business. The insurance market may not be able to cope with several major loss events. As governments take half of some insurance premiums in Australia, perhaps they should use people's money to help them when a disaster strikes. Insurers know that the governments have allowed building in floodplains and other areas prone to disaster. So why should other insureds have to pay for their failed planning decisions? I would mention that the largest businesses self-insure with appropriate catastrophe insurance backup for disasters that cannot be catered for out of capital contingency reserves held. These large businesses are currently lost to the insurance industry as they are able to fund their own asset replacement costs. Insurance brokers are able to design new protection for clients. There are now capital and profit bottom line risk management instruments arranged in capital markets. Alternative risk transfer, securitization, guaranteed bonds, performance bonds, and trade indemnity type covers are developing in the far stronger capital markets as opposed to the insurance and reinsurance markets. Capital markets are far larger and better able to cope with catastrophes. A number of websites explain this emerging new risk management market. A 1-point change in the US stock market is worth about $100 million, yet 40-point changes some days seems to cause no great problem to that capital market.